Chapter 21 is going to introduce accounting for accruals, deferrals, and reversing entries. We've talked a little bit previously about accruals and deferrals, but you're going to get it in a little bit more detail in this chapter. All of this in Chapter 21 centers around the accounting concept matching expenses with revenue. We need to make sure that anytime that we are projecting that we have earned revenue, that we are also accurately recording any expenses we incurred in an effort to earn that revenue. That's the whole idea behind that matching expenses with revenue concept. But there are some revenues, such as interest income, that are earned but not recorded until we actually get the money. And on the flip side, there's some expenses we might incur before we actually have to write a check for them. For example, notes payable is a good example of that. We are incurring expenses every day, but we don't write a check for that until it comes time to take care of the notes payable. Those types of entries, any entry recording revenue before the cash is received or an expense before the cash is paid out, is called an accrual. And the examples on this slide here, interest income, usually coming from a note receivable, or interest expense on a note payable. Those would be considered accruals. Now, on the opposite side, we have what are called deferrals. Revenue, such as rental income that we might get before we've actually earned it. For instance, if someone pays 6 months rent up front, we haven't, we haven't actually earned that money yet, but they've paid it up front. And some expenses that we might do the same with, we might pay rent up front. Expenses that are incurred or revenue received before it's actually earned, we need to do an entry that records that cash received or cash payment. That is called a deferral. And there again, rental income or rental expense. Cash is recorded when it's received or paid. The revenue or expense is recorded in a future period. Now, by doing this, and we've done this in the past by doing adjusting entries, by showing that we actually had earned income or actually had incurred expense, we made an adjustment at the end of the fiscal period. But that's all the further we went with it. This chapter is taking it another step by doing something called a reversing entry. It's an entry made at the beginning of a fiscal period, usually right away on January 1st, and it reverses an adjusting entry from December 31st. And it is exactly what it sounds like. It literally reverses the adjusting entry. You literally flip it around. So in this example, our adjusting entry here, interest receivable was a debit, interest income was a credit. So what we're saying with this entry is we earned $175 in interest, but we haven't gotten it yet, so it's an interest receivable. This should look familiar. We've done this before. Now, though, come January 1st, we're going to do a reversing entry. We use the heading reversing entries, and we literally reverse that adjusting entry. We debit interest income and credit interest receivable. Now, by doing this, we've reduced our receivable account, so it just is kind of a wash. It went in and it went out. But our interest income was a temporary account. At the end of the fiscal period, we zeroed it out. It had no balance, and normally it would have a credit balance. By doing the reversing entry on the first day of the fiscal period, we have now put a debit balance in interest income, an account that normally has a credit balance. But that's okay. There's a good reason for doing this. When it comes time to collect on that note receivable, our entry will look something like this. We receive cash for the maturity value of a note. We have the principal, we have the interest for the entire period of the note, that 90 days, and then the total amount received. So we're going to debit cash for the total amount received. We're going to credit notes receivable for the principal amount of the note. Now I've got this interest, this $262.50 in interest income, because I did the reversing entry over here, and I ended up to start the fiscal period with a debit balance in the account. When I receive the cash, I don't have to try and revert back and remember what I did. I can do it just like normal. I can credit interest income for $262.50. And my new balance in interest income, $87.50, correctly will reflect the amount of interest I earned in this fiscal period. The 175 was last fiscal period. 8750 was this fiscal period. I can correctly reflect in the correct fiscal period when I earned the money. And I don't have to do anything different when I get my check because I did a reversing entry. So I record it just like normal. I'm going to credit notes receivable for the principal. I'm going to credit interest income for the total amount of the interest, and I'm going to debit cash for the total amount I'm getting in the check. I don't have to try and remember what I did. Now this, granted, is only January 30th. It could be June 30th before I get paid on a note receivable. That's a long time to try and remember back. So the reversing entry helps with that. Now on the flip side, I might have accrued interest expense. At the end of the fiscal period, if I have expenses that were incurred but I have not paid, I'm going to do an adjusting entry. And we've done this before. Okay, we've done our adjusting entry. We figure up how much is in that fiscal period. So in this case, I have a long-term note payable. I have my interest rate that I actually owe on. I owe my 8% on that principal for 30 days, but I don't have to write the check yet, but I've actually incurred the interest expense. So on December 31st, I do an adjusting entry. I debit interest payable and I credit interest expense for the $710.84 because I actually incurred it in the first fiscal period. So here's my adjusting entry in my general journal on December 31st. Debit the expense, credit the payable. Now, I'm going to reverse that with a reversing entry on January 1st. So my expense account, I did my adjustment. I zeroed out the account by closing it. So then on January 1st, when I do the reversing entry, I actually credit interest expense, so it looks funny because expenses don't have a normal credit balance. So it's going to look a little bit different. My interest payable account, I adjusted, then I reversed, so it was just a wash. It puts it in and it puts it out. So my interest payable doesn't see a lasting effect. So I have my reversing entry here. Then, when I actually get ready to write the check, paying the installment on the note payable, so on January 1st, I actually wrote the check. So this one's pretty easy because my interest really is the same as my adjusting and reversing entry. So I wrote a check for $2,433.17. I have my expense and then the reduction of the principal. So I can go ahead and do my entry just like normal. Debit long-term notes payable for the reduction of the principal. Debit my interest expense, which now will put my interest expense back at zero because I had that credit balance in there. And I can credit cash for the total amount of the payment. By doing the reversing entry, I don't need to do anything different here. Now, reversing entries are not required. There is no generally accepted accounting principle that says you have to do reversing entries. A company can choose to do them or not to do them. But it really is in their advantage to utilize this and make it part of their practice because it will help prevent double charges. When you're doing your closing entries and you're doing your end of the fiscal period work, a reversing entry can be done right away while the math work and the calculations are fresh in the accountant's mind. Then when payments are made or received later throughout the next fiscal period, you don't have to go back and look up and try and remember what had happened at the end of the year. You use a reversing entry. General rule of thumb, you use a reversing entry whenever an adjusting entry creates a balance in an asset or a liability account that initially had a zero balance. So if that adjusting entry creates a balance, then you really do want to reverse it. Adjusting entries for accrued revenue and accrued expenses must be recorded at the end of the fiscal period so that your financial statements accurately portray the correct income and the correct expenses. That's why we do adjusting entries. Each accrual entry affects a balance sheet account and an income statement account. So if it's not recorded, both your balance sheet and your income statement will technically be incorrect because you are not accurately recording and publicizing to the general public or whoever might look at your financial statements what you earn and what your expenses are. Now, there's a lot of information in this first section. Even though there's only just a few terms, there's quite a bit of information. So you want to make sure you read that first section, take the time to do that, take some notes on it, and then go ahead out and